Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, will visit China next week as his government tries to rebuild a relationship and reduce Canada's economic reliance on the U.S. Carney set to meet with the Chinese leader, President Xi Jinping, with discussions focused on trade, energy, agriculture, and international security. The trip marks the first by a Canadian Prime Minister in more than 8 years. The Trump administration says Washington will control sales of Venezuelan oil indefinitely. U.S. Energy Secretary Chris Wright says sanctions on the country's oil sector would be waived to facilitate exports. The comments come a day after the U.S. president announced Venezuela had agreed to ship up to 50 million barrels of oil to the U.S. That move could yield revenue of more than $2 billion U.S. dollars. The White House says the proceeds will be held in Treasury accounts. And shares of Lockheed Martin and Northrop Grumman are seeing some pressure today. The U.S. president says he will not permit defense companies to issue dividends or stock buybacks until those firms address his complaints about the industry, including speeding up production of military equipment. In a post to Truth Social, Trump says massive shareholder dividends and buybacks are taking place at the expense of investing in plants and equipment. The president also took aim at executive pay packages. Home sales across Toronto saw a decline in December, along with the average selling price. Data from the Toronto Real Estate Board showing sales fell 0.4% versus the month before, while the price of a home fell 5%. Now, annually, sales fell by more than 11% as buyers failed to return to the market despite the lower interest rates and more listings. The board says economic uncertainty weighed on the housing market throughout the year. Here's where we are landing right now on the North American markets. For the TSX, a 287-point drop today after back-to-back record closes. 32,120 is where we stand. Let's go south of the border. The S&P 500 has not moved much so far on the day. The Dow Jones, though, dropping 461 points, or almost 1%. And the Nasdaq is up today 58 points, or 0.25%, taking it to 23,606. After those back-to-back record closes to start the week, the TSX down several hundred points, as you saw. Our next guest says the bull market is still alive for 2026. Let's go to Brian Belsky, CEO and CIO of Humulus Investment Strategies. Thanks for joining us today.
Thank you so much for having us, and good afternoon, Canada.
You expect positive returns this year, but more muted in nature. What are you seeing that paints that picture?
We do for both markets. You know, Canada had an amazing year last year, as you know, from an absolute performance basis. When you look at local currency, it's its best absolute performance since 1990. That was really driven by two out of the big three sectors had a wonderful year, especially materials driven by gold. But I do think that relative outperformance is probably going to wane in 2026, especially given the more diversified nature of the U.S. market, number one, and number two, just kind of some of the gas is going to come out of the momentum. Here's why. Canada, for all intents and purposes, is a much more cyclical market than the United States. The United States is more of a secular growth market. When you take a look at how the markets in general in North America, both Canada and the United States, have been driven for the last 4 years in particular, it's been about multiple expansion. When we go back and look at our historical studies, long-term strategies, we've been doing this for 36 years or so, we found in our backtesting and our analysis that principally multiple expansion-driven markets, which have been the markets the last couple of years, are the most powerful. in earnings-driven markets, although still positive, are not as powerful. We believe that both Canada and the United States are entering an earnings-driven market. Doesn't mean it's bad. It just means it's not going to be as good. And you can just kind of take 2 steps back and think about it as positive is still positive. And we still think investors should not time the market, remain invested, and own the best kind of high-quality companies in Canada that Canada has to provide.
Okay, you also say it's going to be a bumpier ride this year than last. Last year was pretty bumpy. What are you attributing the bumpiness to?
Well, let's take 2 steps back. It was bumpy for about 2 weeks, right? And then the market rallied back pretty strongly, which showed the resiliency, especially of the U.S. market. Part of that bumpiness was driven more by fear than fundamentals. We had exogenous events at the beginning of the year with respect to what was happening in the United States in terms of policy. But bumpiness, quite frankly, is, again, when you transition more from a momentum market and a valuation-driven market versus earnings. Now, again, if you take a look at how Canada is as an index and with its companies, it gets much more cyclical. So we think the earnings growth in Canada is going to be more cyclical and a little bit less discernible than the United States, which could cause some of the bumpiness. But again, that doesn't mean that you should be selling. I think most investors typically, in my experience, sell at the wrong time. So you're going to have some weakness, then they'll sell. We certainly saw that last year when a lot of private wealth investors that we speak with all sold the U.S. in April and have not come back. So that they've missed a heck of a run with respect to what happened in the U.S. between April and the end of the year.
All right. So how would you caution investors, if caution is the right word?
I don't think caution is the right word. I think you have to be disciplined. And again, if you take a look at some of those areas that have been super, super strong, like gold, why don't you take a victory lap and take a little bit off the table? It's okay. Or some of the banks have been very powerful in Canada. Most of that power, quite frankly, of the big five and the sixth one in Canada has really been driven by those banks over-reserving. So they had excess cash, and with those excess cash, they created earnings and paid off bigger dividends. Over the short term, that doesn't really last. Over the long term, it does, but over the short term, it really doesn't last. So we think some of the gas could come out of banks in particular. And so we've been more neutral heading into 2026 for banks. So I think you have to be a little bit more process-driven, a little bit more disciplined, but remain invested longer term and increase your stock picking instead of just buying a broader index, meaning you want to be buying up individual companies, we think, in 2026 versus just buying an ETF-driven TSX product.
Okay, I was going to ask you what your themes are for this year, because, of course, AI was a big theme last year. People were buying up sort of everything they could. But you're saying not certain sectors to look at, but certain stocks.
Yeah, we really believe that the AI theme is real. We're going to see increased dispersion. It's not going to be just because every stock has something to do with AI doesn't mean it's going to go up. I think we're going to see very specific themes in AI, especially around the utility space. We think a lot of the old school utility companies that are going to benefit from a lot of these AI companies and data centers needing more power. You think about it. How do companies generate power? They plug themselves into the wall. Who owns the plugins? Well, Fortis and Canadian Utilities. So, I mean, those types of names, I think, are underexposed in a lot of people's portfolios and not really understood. I think from a contrarian perspective in Canada, the communication services area has been way oversold and way under-owned. And we also think consumer discretionary. If you think about the resiliency of the Canadian consumer, everybody talks about how strong the U.S. consumer is. Man, the Canadian consumer is excessively strong, and that's why we continue to love names like Aritzia and Dollarama are our two favorites.
Okay, those are good ones to watch. We thank you for joining us today. Brian Belsky, appreciate your time, sir.
Thank you so much.
Coming up, a former Canadian defense minister helps us to unpack American talks to acquire Greenland and what it means for Canada. Back in a moment. Only days after ordering the U.S. military into Venezuela to capture the president and his wife, Donald Trump is now blasting NATO. And the White House says the U.S. president's actively discussing how to acquire Greenland with military force on the table. Joining us to unpack it, Peter MacKay, former Canadian Defense and Foreign Affairs Minister. Thanks for joining us today.
My pleasure, Marla. How are you?
I'm good. How seriously do you take this White House statement about acquiring NATO should Denmark be preparing troops?
Well, look, I think you have to always give ample consideration to things that the President of the United States says, particularly this president. But how seriously do I think the possibility of the United States attacking Denmark is? Not very. I think, number one, there are much bigger priorities for him, although he has clearly coveted the critical minerals and the strategic advantage of having Greenland. But it's another NATO country. They're part of Denmark. There has been a lot of musing and a lot of bombast and a lot of braggadocious nature within this president. But a military attack is one thing. Trying to work out some sort of an association with them, keeping in mind that they have a military base in Thule, Greenland. They now call it Piftik, I believe. But there is a historic relationship there. Concerns about the vulnerability of the Arctic, which Canada shares. The fact that the U.S. has other similar type of relationships with countries where they provide security, that's a more realistic pursuit than any kind of an invasion, in my opinion.
Okay, we often hear Donald Trump sort of go big with the threats only to ratchet it down to come to some sort of agreement. And you're thinking that could be what happens here, some sort of agreement with Denmark and Greenland to get access to what that island offers?
Exactly. And using leverage like this by starting big, as you put it, and then working their way back. But look, the situation in the Arctic is serious. There is concern about Russia. There is concern about China, others navigating in or close to Canadian waters. And so this is something we need to keep an eye on. But, you know, we saw the Prime Minister in Europe telling Denmark, the president there, that, you know, we stand with Denmark and our NATO allies. I think there's plans now to open an embassy there, visits from Canadians. We have to be a little bit careful walking that line, not poking the bear, so to speak. But I really don't think that this is going to be a pursuit, a realistic pursuit by the U.S. administration. And I think people like Marco Rubio are going to try to walk this back at some point in the near future. You
mentioned Arctic security. We know that Canada is trying to beef up the defense of the Arctic as part of its plans to put more money into sort of security itself. So is that threat at this point escalated to a level that perhaps Greenland needs a bigger military presence from the U.S., Canada, or others?
Well, I think I would focus more on what Canada has to do. And we've been in talks now for some time about improving the security around the Arctic. That includes a form of missile defense, although not likely the Golden Dome that the president has envisioned, but certainly finally pulling ahead with the fighter aircraft purchase. We need to recapitalize some of the airfields and infrastructure in the Arctic. Being able to operate this time of year and later into the winter is very difficult. Minus 40, minus 60 in some instances in pitch dark. And those waters are opening because of climate change. And so this has been on the government's radar, successive governments, for some time. But it's a massively expensive undertaking as well, and something we should be doing in concert, frankly, with the Americans, but with other Arctic Council countries. And we are drawing closer to those countries, including Finland and Sweden, who are now NATO allies, and working towards this ice pack realization where we are going to build, in concert with the Americans and the Finns, more icebreaker capability.
Okay, just to pick up on another thing we heard from Donald Trump today, that NATO is nothing and without the U.S., and we've heard the rhetoric before. But I just want your opinion on whether or not NATO could stand without the U.S.
Well, they could and they would. It's obviously not preferable. And I've sat at those NATO tables, to be honest with you, and we've been hearing complaints for some time, rightly so. We were not living up to the agreed upon 2% of GDP spending on national defense. We got close. And during Afghanistan, we were punching above our weight, as Canada has done for decades, but still not really paying our way, paying the freight, so to speak. And that has riled the Americans, successive governments, including Obama, Reagan, Bush, others. But we're getting there now, or so it seems. The commitment has been made. The money has not really been allocated or even identified as yet. So there is still some skepticism about whether we're going to be able to reach that capacity. But look, NATO, it has been and continues to be the most important military alliance in global history. And Canada is a founding member. We need and want the Americans to be part of it. But attacking another NATO country would see its unwinding potentially quite quickly.
Okay, let's also get quickly to another issue, which is a trip by our prime minister to China and a meeting with the leader there. What should the Canadian priorities be for Mark Carney?
Well, I think trying to work out some sort of trade arrangement that at least sees the dropping of tariffs. They have tariffs on Canadian canola and seafood and pork. We, in turn, have put tariffs on aluminum and steel and EVs, vehicles. So working out some of that, I suspect any trip, and I've been in some of those meetings with Chinese officials, there may be talk of human rights concerns towards Uyghurs, Tibetans, Falun Gong worshippers. We've seen Canadians kidnapped. We've seen intellectual property being stolen by China. They have an abysmal record when it comes to human rights. And so those items often come up. So those discussions are delicate. But let's be clear, the trade deficits that we have with the United States, or shouldn't say deficits, we do approximately $700 billion annually. It's much, much less with China, although a lot. So there's capacity to grow, but we're never going to supplant or completely replace that trade with the United States. And again, we have to be careful and cognizant of the fact that China and the United States are on a knife's edge as well. And so we don't want to go too far in suggesting that we're going to sell them our surplus energy, which questionably we can't get to them because we don't have the necessary infrastructure. Nor do we, as we saw in the case of recognizing Palestine or coming down too hard on the side of those who are criticizing the United States, the president takes it very personally. So caution has to be part of that trip to China. I suggest we can also do more with other countries in the region that are more closely aligned, that are democratic, like Japan, South Korea, not just talking to the Chinese Communist Party.
All right, Peter MacKay, sir, I've got to leave it there. But thank you for your time. Appreciate you joining us on The Close today.
Happy to speak to you. Bye now.
Straight ahead, Discord joining the list of a rapidly growing pipeline of venture capital-backed tech listings. More in a moment. Discord, an online chat platform, filed confidentially for an initial public offering. This will add to a rapidly growing pipeline of venture capital-backed tech listings. For more, we were joined by Bloomberg's Carolyn Hyde.
Of course, this is a confidential initial assessment of putting their documents towards the SEC, the Securities and Exchange Commission. So they confidentially file the documents before they then go on a roadshow with investors. So yes, this is hush-hush, but according to some of my sources and those of my colleague Bailey Lipschultz, this has formally gone to the SEC now. And we're even looking as close as a March listing. This is what some of the advisors are currently pushing for, we understand. Look, their advisors thus far, we understand, like JP Morgan, Goldman Sachs, were hired all the way back in March of last year. And we're seeing that finally, maybe Discord has set itself up for the moment to list to the public. Now, this is a company that was valued at about $15 billion back in 2021 when valuations were pretty high. We understand, according to secondary market information, where the trades currently happen in private markets, we're looking more at about a $7 billion valuation for the company. Remember, this is decade-old chat company, origins in gaming. And they very recently had a change at the top. The executives changed. So Ed Citron moved from being CEO and co-founder to being on the board. And they've actually brought in an Activision Blizzard alumni to be the CEO who's going to be able to push forward on the monetization of the business and basically be the person to help take it public.
It'll be interesting to see the response. I told my 18-year-old who uses Discord, oh, they're going to have an IPO anyway. Ugh. Is there the possibility this could drive away a lot of the users because there's a bit of a rebel feel to it?
somewhat interesting that that was the reaction because look, this is a community and it's very much one that feels passionately about the Discord community and might not want the moment where it's democratized, where they have to publicly let everyone know what the growth figures are. But look, there are 200 million monthly users of this product. And in many ways, you could tell your son, this is a democratization moment. Should all the money in funding rounds be going to the venture capital community, or is it a moment where institutional and retail investors are able to dine in on a company's ability to grow, to monetize, to start serving ads? That might be more of where the problem lies for your son. Maybe he doesn't want ads. Maybe he doesn't want that monetization of this particular unique asset. He'd rather that it stayed true to its roots, right? But with scale comes these sorts of problems.
Now, it looks like it's moving ahead. Is there anything that you've heard that might be able to derail this?
Look, I think a lot of this is predicated on where the markets are. Markets are near record high, S&P 500 near a record high. We've seen NASDAQ 100 close to it. And so when you've got great valuations, when you've got volatility, if you're looking at the VIX and other kind of benchmarks at real significant lows, this is a wonderful time to try and put your company public. But Motive is another company that's in the self-driving arena that's looking at the markets, we understand. But there's also the big whales out there. The SpaceX discussion. Will it be 1.5 trillion when it comes to the market? Could it come as soon as 2026? What about OpenAI? What about Anthropic? These are the kind of companies that people are talking about. Maybe if you're a slightly smaller player like Discord, you want to front run that. You want to get in a little bit earlier. So we see if the markets can continue to support it. And also remember, regulation and oversight. We're seeing some of the state governments take a keen eye on whether there's enough safety guardrails, particularly for children using Discord. So that'll be one to watch as well.
Bloomberg's Carolyn Hyde there. Let's take a quick look at the markets before the end of the trading day. The TSX today on a downward streak, 277-point loss right now. It had back-to-back record closes Monday and Tuesday, but at 32,129 just ahead of end of day. Let's cross the border and look at the U.S. The S&P 500 has not moved a lot today, a 25-point drop. The Dow Jones losing 487 points today, almost a full percent. And the NASDAQ has a 27-point move up today, so not a material move for the NASDAQ today as well. We do want to take a quick look at some of the oil stocks, which have been hit this week, especially the Canadian oil stocks. West Texas Intermediate today down 86 cents, taking it to 56.27, so down about 1.5%. Canadian oil, of course, been hit by what is going on in Venezuela. The U.S. taking over the running, quote unquote, of that country, especially of its oil reserves and its ability to push oil out of the country. The closing numbers are coming up next. Stay tuned for that. Here are the closing bells for the end of the trading day. At the NASDAQ today, Weight Watchers ringing the closing bell. And in New York, Intercontinental Exchange is there to celebrate. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite dropping 271 points today, so 0.8%, taking it to 32,135. The S&P 500, not a material move. It's down 23 points today. And the NASDAQ gaining 37 points today, so up about 0.2%. Let's get to the movers in Toronto. Metals moving quite a bit today. Capstone Copper is where we start. It dropped 7% today, or $1.04 per share. Taking the price per share to $13.79. Let's get to Arrow Copper. It dropped as well, 5% down today, a loss of $2.18 a share to $39.98. It is up almost or over 95% in the last year. Endeavor Silver backtracking today. It dropped 4.5% or 66 cents, taking the share price to $13.95. And then Definity Financial on the upside today. It gained 4.8%, taking the share price to $76.94 today. Bausch Health, also a gainer on the TSX, up 3%, taking the share price to $10.95. And getting to OR Royalties, it is up 4.5% today, a gain of $2.31 per share. And finally, Wesdome Gold Mines here, it is up close to 4%. That's a 93-cent gain per share, taking the share price to $24.50, and it is up over the last year 89%. Let's go to Bloomberg's equities reporter Stephanie Hughes. She joins us now for more on the movers. Stephanie, we saw silver stocks move up at the start of the week. Now they're sliding. What triggered the reverse?
Yeah, exactly, Marilla. What a difference that a few days make. So Endeavor Silver is how I kind of focused on these silver movers here. And shares really sharply reversed course, dropping by over 11% at their lowest point, which had been its largest leg downward since October. And it had been falling fast alongside other precious metals names today after silver and platinum prices collapsed given the market tightness and potential for U.S. tariffs. I should add that Endeavor did manage to reverse some of those losses as the trading day went on, but still ended the day in the red, as you mentioned in your opening remarks there. So silver is retreating from its record high of just above $84 an ounce in late December, just given the reweighting of commodity indices, and that led to some large-scale selling, which happens sometimes. So while geopolitical tensions between the U.S. and Venezuela at the beginning of the week really brought traders flocking to safe haven assets like precious metals, those same traders are now focusing on U.S. economic data coming out throughout this week to offer more clues on what the Federal Reserve rate path might look like. So that's all just crushing a lot of the silver, TSX-listed silver names today, including Endeavor Silver, like I mentioned, First Majestic, which I had been talking about yesterday when it was well into the green, Aya Gold and Silver, and many others, Morella. So it's been a blink and you miss it kind of a trading session.
Yeah, if you didn't get in, you were trying to get in ahead and then drop back today. Let's get to Algonquin Power, a gainer today. What spurred that?
Yeah, so that stock jumped by nearly 7% at its highest point, which had made it the top TSX performer at the beginning of the trading session before it was overtaken by Definity. And it briefly brought the stock price to its highest level since May 2024. And that's because National Bank analyst Vital Sidhu boosted his team's recommendation on the utilities company to an outperform rating from a sector perform rating. That's kind of like moving a stock to a buy from a hold. And so basically they expect that the company will have its new utilities rates approved by regulators in a formal process called rate cases. So the team expects that they'll have these approved and implemented, and they'll be able to essentially charge consumers higher rates. So they forecast that this should boost earnings per share on a year-over-year basis by about 10%, up to 20% by next year. They also added that Algonquin was able to really get together a strong team that can execute, can really drive execution and focus on a disciplined capital allocation strategy. In particular, they focused on the new CFO, Rob Stefani, and the Chief Operating Officer, Peter Norgeau, Morella. So it's that's a good endorsement from National Bank, and apparently traders agree with that assessment because you can see that reflected in the share price.
Yep, they are liking that. All right, Bloomberg, Stephanie Hughes, thanks for the update. Let's go south of the border and get to the movers in the U.S. Bloomberg's senior equities reporter, Bailey Lipschultz, joining us now. A lot of news coming out from Donald Trump and Washington. Trump says he's going to ban big investors from buying single-family homes. Can you give us some context here and tell us how housing stocks reacted?
Yeah, a little bit of context. Well, it seemed like earlier in the week, Jensen Huang was the one moving the markets, but now we are back to President Trump moving markets. So some context around his post, basically pushing out the idea that people live in homes, not institutions. So pushing, according to a Truth Social post, to ban and make it more difficult for institutional investors to buy and acquire single-family homes. So that hit stocks like Blackstone, a company that has made quite a bit of money on paper from single-family homes through some of their roll-ups. And then also, we saw it strike out at a number of home builders like Lennar, as you can see, down more than 2%. So this was a pretty sharp sell-off for Blackstone. We saw Lennar, we saw Pulte Group, other home builders under a bit of pressure. Even companies that make things like decks and other products for home building, kind of add-ons to soup up houses, under pressure, just given the uncertainty of what this could mean. If you want to look at it from a high level, if institutions aren't able to buy homes, that can provide less of a lift to prices, which then, if you look down through the cycle, could pressure on the need for either building new homes or the ability for people who are maybe upgrading homes if they can't afford a new kind of town to upgrade their houses. Again, a lot of uncertainty around this, how this actually is implemented, but Wall Street likes to sell stocks first and ask questions later.
Yeah, it often does. Okay, he's also talking about stopping defense companies essentially from paying dividends or doing stock buybacks because he wants them to focus on pushing more product out and investing in that. First of all, how are defense stocks reacting? And again, can you give us any clarity on how this would work?
I think there is no clarity on how that actually works. I don't know and have not talked to anyone who can simply point to a way that the president can restrict or limit defense companies from buying back their own stock or issuing dividends, which these have been big dividend issuers and big buyers of their own stock. So unclear, to be completely honest, how this actually would be implemented. But again, a day where whether it's investors, whether it's algorithms, pushing down these stocks. So as you can see, RTX down more than 2%. Lockheed Martin actually ended the day near its lows. We also saw in aftermarket trading additional selling pressure, if you will, on Raytheon because Trump saying that Raytheon has been the least responsive to the Defense Department. So again, the big question is, how do these changes get implemented? Is it just simply the president trying to encourage companies to invest more and maybe limit compensation for CEOs and other executives? Perhaps. But again, another example on a wonky day like today where we saw these stocks under, again, notable selling pressure. These are big companies down 2, 3, 5%. So it's not small blips on a Bloomberg terminal.
Yeah, we will see what happens as this unfolds and maybe the clarity still to come. Bloomberg's Bailey Lipschultz, thanks for joining us today. So after the break, we'll dive into investing strategies during what are unpredictable times. We're back in a moment. Start of the year has already rocked Canadian oil stocks and rallied precious metals until today. It's only week 2. Let's talk about the year ahead with Martin Cobb, Senior Vice President, Equities at Lauren Steinberg Wealth Management. Martin, thanks for joining us. Happy New Year. Good to see you.
Happy New Year to you, Marella. Good to see you too.
So there will always be curveballs. We know that, especially when you have the kind of administration you have in the U.S. But how are you positioning to start off this year?
Cautiously optimistic, in the sense that, I have no idea where the market might head. But I saw David Rosenberg writing about diversification being a dirty 15-letter word. I thought that was absolutely spot on. I think this may be a year where being diversified is more important than it has been, let's face it, the last 2 or 3 years, where there's only been really one trade in town. So I would say, we can still find businesses in this part of the world and other parts of the world that are great businesses on attractive valuations, but you have to be a little bit more selective. I do think just owning an ETF today, or the S&P 500, or even the TSX, is very concentrated in terms of the types of companies you own and therefore the risks that you're exposed to.
Okay, so obviously we have been very focused for the last year or more on tech stocks with the AI drive. Many of them I know you see and others see as overvalued. Are there other sectors besides tech where you see that same trend of things being overvalued and maybe we need to sort of move away from?
Yeah, I think in terms of overvaluation within the tech sector, we've talked before, Morel, about this, particularly in the private space. The valuations in the funding rounds that you have for the likes of OpenAI, Anthropic, suggesting valuations in the hundreds of billions of dollars, with revenues, in the tens of billions of dollars and profits in the negative. Whereas, someone like, Alphabet or Microsoft, Amazon, there are still some risks there, but they're much better positioned businesses. But yes, if you look around the world, or even just look in Canada, Look how well the banks did last year. We like the Canadian banks over the longer term, but you've seen, I think the worst performing Canadian bank last year was up around about 30%. So a lot of that is just a valuation expansion. So again, it comes back to my earlier point. Still like these businesses in the long term, but just be mindful of position sizes, mindful of the prices you're paying for a number of these areas. Banks would be one, but there's some other sectors or some stocks that just the market seems to have fallen in love with.
Okay. Are there certain sectors that you are staying away from? Consumer spending is some I've heard are staying away from that. They just don't feel necessarily that because of the uncertainty and the economic outlook that consumers are going to continue to spend.
It depends on what you're paying. I mean, that you've heard me say it before, I tend to zig when others zag and vice versa. And if valuations are discounting a lot of uncertainty and a lot of fear, that can be happy hunting ground for me as a kind of classic value investor trying to buy the world's best businesses on sale. So no, I wouldn't shy away from that sector. If valuations, are discounting a worst case type scenario, that can be a great opportunity for those with a longer term view. But I look at some stocks, stick with Canada again, Aritzia here or Dollarama. I know Brian Belsky was talking about them just earlier in the show. I take the opposite view. I struggle with the valuations on those types of stocks to some extent, looking probably to line up a little bit. We still like Dollarama, but the valuation is now discounting a continuation of the very strong growth levels, which, they may soften somewhat.
Okay, so let's zero in on a couple of stocks you do like right now. Compass is one of them. They're a catering group worldwide, I believe. Tell me a bit more about what piqued your interest here.
Firstly, I love finding world-leading businesses that may have the bulk of their business in the US, but they're not US domiciled and therefore traded at a discount. I think Compass fits that bill extremely well. We've never heard of it, but we've almost certainly used its services. They are the world's largest contract catering company. So if you go to a sports stadium, you go to a university, mess hall, you go to, offshore defense platform, there's a chance that Compass or Sodexo or Aramark will be serving you that product. They say they're the world's largest, and it's a great long-term growth industry. A lot of mom and pop type businesses, but also a lot of the industry is still in-house. Companies still doing it themselves, and they can save money by outsourcing to the likes of Compass. The reason I got really interested is they did a rights issue, a capital raising during the pandemic, bolstered the balance sheet because let's face it, half their business disappeared. No one was going to sports stadia, educational establishments, etc. We got a chance to pick up the business with a very strong balance sheet, with it strong enough to get it through the pandemic. Very fortuitously, just bought it before Pfizer Friday. But it's a great long-term story that's still attractively valued, 20 times multiple for low double-digit earnings per share growth and a market leader, as I said.
Okay, let's get to another pick of yours, which is Starbucks, which has been going sort of sideways. I know they have a new CEO who's trying to turn things around. They haven't seemed to get much traction so far, even though they sort of laid off managers and have sort of tried to go back to what they used to be, the hangout place, the coffee house. But what do you like about Starbucks moving forward? Do you see sort of a return to what they used to be?
You've hit the nail on the head there, Morel. I mean, back to what Starbucks used to be. I mean, indeed, that's their slogan, back to Starbucks. And, as a customer, and you've certainly seen it in their numbers, we have all felt a little bit alienated with the massive queues, the complexity of the menu. I just have Grande Black dark roast. So I'm the one trying to get my easy coffee, and someone in front of me is getting everything, using my daughter, to be honest. So I do think there's a lot of self-help here. It's not going to be a quick fix. Yes, the stock has gone sideways. The business is now starting to go sideways. That's actually a good thing because you've seen, obviously, real poor numbers in terms of visitors, same-store sales in the US. Now evidence that's stabilizing. They seem to be doing something in China. That business was a great growth engine for them, has stalled, and they're now extricating themselves to some extent. But very simply, if they get back to Starbucks, get back to the sort of margins, mid-teens operating margins they've historically enjoyed, they throw off something like $5 earnings per share. It will take several years, but with an $80 plus share price, that's a very attractive price to pay for Starbucks today.
Do you think customers want to go back to Starbucks? As a Starbucks consumer in the past, do you think customers want to return and pay that $7 for a cup of coffee these days?
It may not be the $7. They have to be price competitive. And we are in an environment absolutely, hitting it on the head in terms of affordability issues, whether it be here in Canada. You've seen how well Dollarama's done as a business. all the chatter about affordability in the US, and it's obviously preying on the administration's mind. So the $7 coffee, you know, I've never paid $7 for a coffee. I never intend to pay $7 for a coffee. That part of the business, you know, may struggle to some extent. But if they can get back to that community, you know, third place, as they called it, offering competitive products quickly and efficiently, I believe there's a lot of upside in Starbucks from here.
I believe you probably paid a $7 Frappuccino magic thing for your daughter if you haven't paid for a $7 coffee yourself. You know, they love those things with the whipped cream on top. All right, Martin, thanks for joining us. Appreciate it.
Thanks, Marilla.
Coming up next, the Prime Minister will visit China next week. We'll break down what that visit aims to achieve when we come back. We have Constellation Brands reporting third quarter earnings at the end of the trading day, beer and wine staple, of course. Here is what we've learned. Analysts were worried about slower beer sales and lower revenue because of recent divestments. So here's how things actually panned out. Comparable earnings per share coming in at $3.06 versus $3.25 year over year. The estimate had been for $2.64. So a beat on the estimate with that $3.06 number coming in. Comparable net sales coming in at $2.2 billion, and that's a drop of close to 10% year over year. The estimate had been for $2.16 billion, so they did beat, but again, it's a drop of 10% from the previous third quarter of 2024. Beer net sales coming in at $2 billion. Estimate had been bang on at the same, 2.01. Wine and spirit net sales coming in at $213 million. The estimate had been for $161.8. So a pretty big beat in wine and spirit sales for Constellation. Here's the forecast for the year. They see enterprise net sales growth -4% to -6%, and beer net sales growth -2% to -4%. The Prime Minister's office confirming Mark Carney will make an official visit to China next week. For more on the developing story, we were joined by Jacques Shore, Government Affairs and Trade Partner at Gowling.
There's a lot that's happening in the world, and no doubt he is preparing himself for some interesting conversations as well. It has not been easy for us to really determine where we go and what we ought to do with regard to China. I've used the expression in the past, every 5 years we have to figure out how we figure in when we deal with China. But when you look at that against the juxtaposition of what's happening, we just saw Maduro basically captured out of Venezuela. We look at the conversations that have been taking place recently out of the White House and maybe some of the strong wording coming out with respect to Greenland. It puts Canada in a position where it has to think of these things very strategically. We have to be very careful. I think, first of all, absolutely. I'm always reminded by the fact that Americans are our best friends. They are great friends of us. As difficult as it is to deal, perhaps at the moment, with the current administration, bottom line is our relationships are strong. We're allied to the United States. We have many significant arrangements in place, aside from CUSMA, aside from decades of working together, but also NORAD. And how that sort of plays out in the context of how we then address issues with China is important. We obviously want to diversify our trade activity. We also have to make sure that we are careful in terms of what arrangements we pursue with China. But at the same time, no, there's no question we're not going to have a trade agreement with them. But I think the idea to perhaps strengthen the relationship from a diplomatic perspective, cultural perspective, otherwise, that could also be helpful to our American friends. That could be helpful because in the past they played that role of being able to be a mediator, intermediary, and work certain things out together. So I think at the moment what we have to do is focus, as the Prime Minister is, diversifying our trade activity, recognizing our strengths. I think that the last few days have demonstrated we need to sit down with the Americans very specifically in dealing with what is going on in the context of the conversations on Greenland. We are neighboring to Greenland. We have a tremendous affinity in working together on the Circumpolar Group with special relationships there where Canada, I think, can play an important role in maybe minimizing some of the tough talk or things that are going on. When we're looking at something like Greenland, which is, one can call it an unsinkable aircraft carrier, we have the ability in the north of being able to address the issues of sovereignty in the north and also defense issues, which is obviously so important to the Americans. And obviously, it's important to the Americans because they look at the Northwest Passage. They look at the way climate has obviously affected our north. And what does that mean then for Russia? What does that mean for China, who are on the other end of the spectrum in terms of how our thinking is on a number of issues in our value?
The Northwest Passage for us is a bit of a wild card with this because a lot of people look at it as an international waterway. Canada says, no, it's ours. And America, if they're serious about Greenland, then why wouldn't they be serious about looking at some of our islands up there, Baffin and other ones that are virtually uninhabited? And they would maybe say the same to us and want to say, we want to buy that.
Excellent point. And that's why I basically look at the nature of our relationship, working with our American, I think really congressional leadership in the United States, for them to absolutely understand, appreciate that we are that much better working together. Why would they have to make that kind of investment when we are already in the north willing to address these issues in a very meaningful way, in a strategic way? And let's face it, we are aligned in terms of how we address those issues in the north in ways that I think are extremely important. And, I look at critical minerals. I look at the ability of being able to grow opportunities together with Americans without having to intercede and take over anything. It's how we can actually manage those relationships together. Mark Wiseman, our new ambassador, has his work cut out for him. And I'm absolutely confident that in the way in which the Prime Minister and the new ambassador are addressing these issues with others, we will succeed. But again, comes down to how do we deal with China in a way that's beneficial, extremely beneficial to Canada, but at the same time not going to in any way affect our relationship with the United States, which I think has to be for us at the moment a key priority, along with Europe and along with the other like-minded countries that are our allies.
And just quickly before we go, if you can, how much of a factor will Venezuela be with CUSMA with the negotiations, do you think?
I think that's an excellent point. I don't think it'll have an effect on that. I think that I think obviously, there are issues that will come into the context of energy, but the fact of the matter is the output of oil from Venezuela currently is at 1%. 10 years ago was 2%, so it's not like that's going to make any significant difference. Our oil is a far, I would say, a far better one to basically refine and to deal with. And I think at the end of the day, our markets, I think what I see is opportunities for us to look for new markets, as Danielle Smith has said, but at the same time, focus on what we do best in being able to get that oil to markets. And I don't think I'd be that concerned about, at this moment, I don't see the competition coming from Venezuela.
Jacques Shore, Government Affairs and Trade Partner at Gowling. Coming up, new data shows the Toronto housing market ended a difficult year with a double-digit drop in sales. Back in a moment. Home sales dropped by double digits in Toronto last year. Let's dig into all the reasons behind that with Darren King, senior economist at National Bank Capital Markets. Darren, thanks for joining us today.
Thank you for having me.
So borrowing rates, we know, came down, clearly not enough to get potential buyers out there. They had other concerns. Was job security likely the biggest?
I think the real factor behind the drop we had this year was definitely all the uncertainties we had with the trade conflict with the U.S., which really shattered consumer confidence. Obviously, people were asking themselves if they will remain with a job over the next few months. So that really had a huge impact on the number of transactions we had during the year, definitely.
Okay, so we know that tariffs were a big concern at the start of the year. Some of that noise died down towards the end of the year. Are you surprised we didn't see a bit of a turnaround by December?
Yeah, I think we've been a bit surprised that the latest interest rate cut we've seen by the Bank of Canada did not really pick up really much more transaction to the market. Also, we've seen better job numbers over the past 3 months now as well. But yes, we were a bit surprised by that. But definitely, I think we're starting 2026 on a good footing, and we're expecting probably a higher number of transactions. But there's still plenty of uncertainties that we'll probably face during this year. Obviously, consumers are getting used to it, businesses as well. So maybe they'll be more secured about their job situation and will be able to take action into the market. Let's hope for that, obviously. But still, we're facing definitely headwind with the new all the changes with the immigration policies. That's another drag that will continue over the next few years. So we'll probably see a pickup in sales over the next few months, but I'm not expecting really a jump in transaction and still a slight, probably slight decrease in home prices over the next few months and a pickup by the end of this year.
Okay, so let's talk about Toronto specifically in the sense that is there just a bigger mismatch in Toronto because of the glut of condos we've talked about all of last year, and perhaps that's not what is wanting what buyers want, and that perhaps is just what's sitting around and being that dragged down on Toronto's market?
Yeah, I think definitely there's a mismatch, definitely with the units that people want and what is available on the market. But we saw a record number of new listings on the market this year, the highest number of new listings since the data began in 1980. But I think there's two other factors that are at play here. First of all, affordability issues in Toronto remains one of the biggest issues. It's one of the least affordable city in the country, and obviously when you're facing that kind of uncertainty, then affordability issues are amplifying that uncertainties. So because it's a big financial transaction, and it's really difficult for people to take such risk in that kind of market. Also, we've really seen a bigger slowdown in the job market, especially in Toronto, with plenty of student immigrants coming into the city. And obviously, those are the people that are the most impacted when we're seeing a general economic slowdown. So I think that's two other factors that might explain why Toronto especially we saw such a slowdown this year.
So Darren, as you know, the government's trying to get first-time buyers into the market. They're offering different initiatives that will come out this year to try and get them to get off the sidelines. Do any of them sound like they're enough to make that happen?
I think when we're talking about incentive to get new first-time home buyer to the market, when we're playing on the demand, it's always a double-edged sword, because if you're giving easier, if you're putting easier norm or easier way to get a mortgage, then it will push price up again, and that will counterbalance in some way the impact that you want really for first-time home buyer. I think the only solution that we really have for the affordability issue that we're facing at the moment is really to put more supply into the market, listen to customers, what they really need. We have been talking about, obviously, the condo market, especially in Toronto, that is definitely sluggish at the moment, given the fewer investors into the market. So I think that developers really need to assess what is the consumer need at the moment, put more supply on the market, and definitely that will take several years before we really achieve a better affordability condition in Toronto.
Okay, you touched a little bit on sort of what you think 2026 will look like. Can you expand a little bit more on the Toronto market and what you foresee, given, as you mentioned, the uncertainty is still around as far as people's jobs go and whether or not they're in a good place to make those big buys?
Yeah, obviously, we'll probably continue to see plenty of uncertainty during the year, especially with the USMCA negotiation coming probably by the end of this year. But I think that people are getting used to the trade situation with the US. So they'll get used to that kind of uncertainty. So that will probably help the market to pick up, the resale market to pick up in the coming months. And like I said, we are starting to see see the job market that is also getting better. So people will be more confident about their situation. And thus, we're expecting a pickup in transaction because of that. Interest rate also declined during fall. We haven't seen the full impact of that the monetary policy easing yet. It will come into the year. So all those factors are positive, but obviously, Toronto is probably the city in the country where the immigration policy change is the biggest drag. Of course, the biggest impact in the short term is really on the rental market because most of the immigrants are really in that segment. But usually it takes approximately 3 years on average for a new resident who want to become a homeowner to do so. So it will be a drag for the next few years. But the good news is that it won't be a really hard hit in 1 year, but it will be split over the next few years. So I think that the market can perform well still in that condition, but probably not at levels we've seen during the beginning of the pandemic, for example. So we'll probably have moderate level of transaction, but probably a better year in 2026 than what we had in 2025.
So a bit of a longer, slower drag. All right, Darren King, thanks for joining us. Appreciate your time.
Thank you very much.
So as Canada looks to build relations outside of the U.S., Mark Carney, the Prime Minister, will go to China next week. We'll talk about that when we come back. The Prime Minister, Mark Carney, will visit China next week, the first time a Canadian leader will visit that country in about 9 years. Joining us to talk about this is Sean King. He's Senior Vice President of Park Strategies. Sean, thanks for joining us today.
Good to be with you.
Let me take a look back at what the conversations between the leaders of Canada and China used to be about trade, of course, and what can be traded and what each country has to offer. But it would always include, at some point, a conversation about human rights. So that's what it seems, which is an issue in China. Do you expect human rights or anything contentious to be part of the conversation this time around?
I hope so, but I always fear the worst. Let's go back 2 prime ministers. You know, when Justin Trudeau came into office in 2015, I think he had visions of continuing his father's legacy, who would established formal diplomatic relations with Beijing in 1970, 2 years before Nixon even went to meet Mao Zedong. And he really went there with an open hand. And then after we unfortunately left TPP in 2017, he saw trade with China as a great way to help make up some of the difference. But Beijing did not appreciate Mr. Trudeau's so-called progressive values and trade policies. And I remember when he went to Beijing and Guangzhou in 2017, he left instead of signing a trade deal because Beijing didn't want to agree to things like gender equality, women's rights, environment, labor rights. And I give Justin a lot of credit for not just taking any deal to take it. And then, of course, 1 year later, almost to the day, Meng Wanzhou was arrested at YVR, and the 2 Michaels were illegally detained for several years there on the mainland. So. Yeah. Canada-China relations have been in a nosedive, and I don't really know where they're going to go now, but I understand that Mark Carney needs to look for alternatives for markets, trade, because things are so bad between our own 2 countries right now.
Yeah, he definitely needs to look at other avenues, and the market there is huge. China wields trade as a weapon sometimes, you know that. Can Ottawa hope for an agreement that avoids using tariffs as a weapon?
Well, apparently we do the same thing, too, these days. So, I mean, we're maybe not that much better. But China has a history of coercive economics. People like Norway, Sweden, South Korea, the Philippines, they've all felt this wrath. And back when the US and Canada were on the same page, we together imposed 100% tariffs on Chinese EVs. And then China responded by putting tariffs on canola products, pork, and seafood. And the Chinese ambassador in Ottawa has said that if you lift the EV tariffs, they'll lift these other tariffs. So I think that's what could happen at best. But I think we're far way away from a trade agreement between Canada and China, and certainly no talk of an FTA, a free trade agreement, because there is a clause in USMCA that says it can be terminated if any one of the 3 members establishes a free trade agreement with a non-market economy, which China is.
Okay.
So I don't think a trade agreement is feasible, and I don't even think Carney will mention FTA, because that could trigger a dissolution of USMCA, which is still much more important than any trade Canada does with China.
Okay, let's get to talk about U.S. reaction more in a moment. I'm wondering what state the Chinese economy is currently in and whether Xi Jinping will be more open to a discussion with Canada, because China's facing tariffs in the U.S. As you mentioned, they have not come to terms on what they're going to do with trade. And it seems that the agreement they've been looking for, it seems elusive.
I think China will definitely be open and receptive to Canada and try to play the good guy because of tensions with the U.S. I think Xi Jinping sees this as a time to pry Ottawa away from Washington. I don't think that's going to work, but we see China now in a dispute with Japan over Taiwan language in the Japanese diet. So now China's cozying up to South Korea, sort of a good cop, bad cop thing. So I would expect China to definitely open up to Canada. Whether or not anything real comes out of it, I don't know. But I think we could see a lifting of tariffs in both directions on Chinese EVs in Canada, and then on those food products and canola products in China from Canada.
The EV situation would be dramatic if those vehicles were allowed without the 100% markup that currently exists to give Canadians that choice. But what are the other Canadian industries that could benefit from some sort of agreement with China moving forward?
Well, obviously, steel and aluminum. I mean, and not steel and aluminum producers, but at least the construction industry, because then they would have cheaper alternatives and not have the tariffs on Chinese products. Obviously, any kind of electronics, but then going back to the Huawei issue, we have security concerns, tourism, different kinds of investment, real estate, obviously. But right now, I'm looking at the EVs and the food products in both directions as the major possible low-hanging fruit here.
Okay, we touched a little bit on the U.S. and the fact that the North American Free Trade Agreement, as it was once called, could be affected if there is a trade agreement with China. How do you think even these discussions will affect Canada's relationship with the U.S., if you think they will?
I think Trump will needle Carney with it if he wants to, but really Trump's not in a position to complain because he himself is going to Beijing in April and is apparently negotiating his own trade deals with China. Now, how Venezuela fits into that, I really don't know. But Trump will probably use it to complain and poke Carney, but really he can't complain because he's doing the same thing himself.
Yeah, and we're also going to see some of the oil that Venezuela would provide to China now getting turned around and going to the U.S. So there's even more reason to look to Canada for certain things. All right, Sean King, I got to leave it there. Thanks very much for joining us. Appreciate it.
Thank you.
Coming up, some hot picks in pharma, including one company which is in advanced talks to acquire a company for $1 billion US. More in a moment. Time now for hot picks in pharma. We were joined by Evan Seekerman, Managing Director at BMO Capital Markets, and we kick things off with why he likes Gilead Sciences.
Gilead is the leader in HIV treatment and prevention. We are very bullish on their long-acting prevention asset called Yeztugo. We also like that they are making really good headway in the cell therapy space. So these are cell treatments to treat blood cancers. We think they're going to be very competitive in the multiple myeloma area, kind of competing against J&J and Legend's Carvykti, potential approval later this year. So beyond kind of the fundamentals of the company, and they also inked a deal with the Trump administration late last year, kind of taking some of investors' fears off the table regarding MFN pricing or most favored nation pricings for their HIV business. They have a lot of capacity to do transactions. I think that they've really done a good job of cleaning up house, tightening up their P&L, looking at their expense base. And I think that they are in this growth mode and can execute very well into the end of the decade, driving superior returns.
And HIV is still a big enough problem for a company to make money from medications in this area?
Great question. Yes, it is. There are, millions of people living with HIV globally. And beyond that, they are working to prevent new HIV cases. So that's really what's key. They have a long-acting product called Yeztugo I had mentioned, and we believe that's going to be the market leader. So we see strength in that franchise into the 2030s.
Your next idea is a company called Disc Medicine. Its symbol is iron, I-R-O-N. Tell us what's their main focus?
Great question. So this is one of our biotech picks. The reason why their ticker's iron is because they deal with the blood, hemoglobin, and iron, kind of a little play there. But why we like Disc Medicine? So they were a recipient of the Commissioner's National Priority Review Voucher. So one of the special priority review vouchers given to kind of assets of high unmet need for a drug called bitopertin. Could be approved this month. They had some really good phase 2 data. And for a small biotech company to have an approved asset, 3 or 4 years after they kind of did the reverse merger is really impressive. Beyond that, they have a drug looking at anemia associated with a blood disorder called myelofibrosis. Competitive space, but we really like what they see. So the key here is small biotech company with multiple shots on goal, and that's a unique feature among kind of the universe.
Let's get to Eli Lilly, and maybe can you talk to at all about this news from the Wall Street Journal that they're in talks to buy an outfit called Ventyx?
Most definitely. So we put out a note yesterday, so I'm happy to talk about it. Ventyx Bio is a smaller biotech company. I think the deal kind of in the journal had suggested about $1 billion, so not a huge number for Lilly, right? They have almost unlimited capacity to transact. But what this would get Lilly is a host of small molecule drugs for various inflammatory diseases like ulcerative colitis, Crohn's, other diseases kind of in the cardiovascular system. They also have a drug that allows for inflammatory control in the brain, potentially for Parkinson's disease. So higher risk, high reward. It seems like they're buying a platform and assets that they think they can take potentially forward. May not all work, but really highlights Lilly's focus beyond obesity into the inflammatory space.
Lilly generally is a stock you like, is a big driver of that, the GLP-1 drugs?
Most definitely. I mean, we still believe they are the leader in the GLP-1 drugs. Their lead asset, Zepbound, is the best in our view. We also highlight that their small molecule oral orforglipron likely approved at some point in the first half of this year. Going to go toe-to-toe with Novo's oral Wegovy. A lot of focus on that. But what's key here is we see Lilly continues to execute and provide, create products for all patients kind of on the obesity spectrum, the lower efficacy, think with orforglipron, all the way up to a drug called retatrutide for patients who really need, rapid and sustained kind of deep weight loss. We also like that they have assets outside of obesity, kind of unlike Novo Nordisk, or really where they're focused. Novo is really just focused on obesity and diabetes. They have other assets. But with Lilly, they have, oncology, neuroscience, inflammation, and that diversity gives us comfort in their broad business.
And can you just update us, have these GLP-1 drugs that you just take a pill for, are they actually on the market now? Because I know the industry's been desperate to get them out there.
Great question. So in late December, right ahead of Christmas, FDA approved the Wegovy pill, so the semaglutide Wegovy tablet. And Novo earlier this week announced availability. They are starting via the cash pay channel. I think in the United States, the low dose is $149 a month. Not available kind of outside of the United States, but a lot of focus there. One other thing I want to highlight, I get a lot of questions on the potential for a generic semaglutide in Canada. We got some reports that there are delays for potential approval because of some manufacturing issues. So we're closely watching that. Could come later this year, but could even be delayed beyond that.
So it's semaglutide. It's not semaglutide. Yeah, I thank you.
Tomato.
I know, I'm going to go with what you say, Evan. Why not? Thanks very much. Just before we let you go, because we love hearing your insights on drugs, what else should we look out for in 2026? Is there a big event coming for investors, do you think?
Great question. I think there's going to be a lot more M&A. Obviously, we had the news of the potential news of Ventyx and Lilly, but a lot of the companies that I follow, the big biopharmas, need to buy. So Merck, Bristol, Lilly could buy the European pharma companies. We know Novo is going to buy. All these companies need to add to their portfolios, which is great for the small biotech kind of ecosystem, which is why I highlighted Disc Medicine. And I think that that is going to be a key driver of this space going forward.
Evan Siegerman, Managing Director of BMO Capital Markets. All right, here's how we ended the day on Bay Street and Wall Street. A quick look before we say goodbye. The TSX Composite, 271-point drop, 0.8%, but still above 32,000. Not a big move for the S&P. It's down 23 points. The NASDAQ, a 37-point gain on the day. Thanks for joining us today here on The Close. We'll see you back here tomorrow.